I am joined by Scott Skyrm, Executive Vice President in Fixed Income and Repo at Curvature Securities. Scott, great to have you back on Forward Guidance.
It's great to be back. I always enjoy doing your show.
Scott, you are an expert in repo, the overnight and short-term lending markets. When you came on earlier in this year with Joseph Wang, that is exclusively what we talked about. And I want to ask you about it later on in the show, maybe the last 10 minutes or so. But we've got more pressing matters, Scott. You also, in addition to being an expert in the very niche world of repo, are an author about a book called The Money Noose, Jon Corzine and the Collapse of MF Global. And Scott, I've been hearing the phrase MF Global a lot over the past month, and it has to do with the collapse of FTX, which whose downfall and demise, though maybe slightly more dramatic, was attributed to many of the same reasons. And you wrote on Twitter, a financial company collapses and customer funds are missing. Sounds a lot like 2011. So tell us what motivated you to write that tweet, and what were the similarities between the two situations that you first noticed?
Well, I'd like to first start off and say that in no way would I consider myself an expert on crypto or FTX in particular. However, as you said, if there's one thing in the world I can call myself an expert in, it is the repo market. And MF Global was, very much related to the repo market and their collapse. And MF Global is still a very interesting story. And, as you can see, it's almost kind of interesting, the fact that, these things come and go in cycles. You have a company collapses and customer funds are missing. And then, of course, there's going to be new regulation and it's never going to happen again. But then, of course, it does happen in the Bahamas, multiple times, exponentially larger than MF Global. And so, when I started, reading about the FTX situation in crypto, it was very, very interesting. An exchange, which is somewhat like a broker-dealer to some extent. I think FTX probably had some type of market-making business within it, or within an affiliate. So they're making markets, they're taking risk, whereas MF Global risk, they were long and hedged. I think FTX probably was just long crypto as much as they possibly could. And they probably didn't have any hedge. But anyway, getting back to it, with the situation with MF Global, and there's a lot of moving parts with MF Global, but the main kind of takeaway is that MF Global got themselves into a repo trade, which had to do with sovereign government bonds. So it was the government bonds of Spain, Portugal, Italy, Belgium, Ireland. And Jon Corzine, who was the new chairman and CEO of the company, had come into the company to really ramp it up and make it into a mini Goldman Sachs. And he hired a lot of people. He gave signing bonuses to a lot of traders. And of course, a trader coming in from MF Global, coming into MF Global from Goldman Sachs or a big shop, they don't have the resources and the facilities and the customers to make that $10 million a year in their trading account. It's a lot harder. So what they found was, after a period of time, all these new traders and all these new businesses were not making a lot of money, and Jon Corzine needed a way to make a lot of money. So a friend of mine in London suggested a trade to him. He said, basically, why don't we buy European sovereign bonds on a short-term basis, 1 year at a time? We will fund them in LCH ClearNet, which is just like FICC, and it's kind of an arbitrage trade. They own a bond, they sold it to maturity, and the interesting part was that these bonds of those countries at the time, they were called PIGS, which was Portugal, Italy, Ireland, Greece, and Spain. Their yields were abnormally wide compared to the financing costs. So MF Global got themselves into this trade, which was part of it was a repo trade, and they were making millions of dollars a month on the trade. However, the European debt crisis hit. They had margin calls. They started losing liquidity. As the trades went on, they had a really big trade that they couldn't get out of. It was, I think, 11 billion was the size of it at one point, and MF Global itself was losing money. And basically, the trades themselves were good, but they kept getting larger margin calls because of the European debt crisis. And what happened was, in short, they lost their liquidity. They didn't have enough money to make margin calls. There was a mess in their operations group, and their settlement people started using some of their customer money to make margin calls. And the idea was they figured they were making margin calls, to counterparties and exchanges, and they would get margin in from customers to cover that margin. But at the end of the day, when they're losing liquidity, they weren't getting any margin back from anybody. All the margin was going out. So when they had borrowed from their customer funds to fulfill a margin call, there was no money at the end of the day to put the money back into the customer accounts. And, that was where the real, kind of fraud came in, or I don't know if it's really called fraud, but that is, being in a bad trade and losing money is generally not against the law. But, using customer funds to finance your bad trade is against the law, taking the customer funds. And in a nutshell, that's really kind of the MF Global story. And if you look at FTX, from what I know so far, I won't be surprised if they ended up having margin calls. They needed to come up with cash, which might be coins. They need to come up with some coins, and they were borrowing coins from potentially their customers to make margin calls, to keep their business afloat. So I would say that's probably going to be what the fine parallel is between the two.
Right. So it's that use of customer funds from what's called a seg account. That is the ultimate no-no in finance, in broker dealers. So MF Global, it was a brokerage for sort of macro products. So, you want to go long or short oil, you want to go long or short soybeans. That's in the physical world for commodities. Then you can also do interest rates, which are non-physical. And so customers were making those bets on the platform. And MF Global, I learned from your book, they made money because the cash was there, and they could earn income from extremely risk-free, extremely low-risk securities such as treasury bills, so like a 3-month treasury bill, or even a 18-day money market fund or something like that. And so when interest rates collapsed in 2008 because of the global financial crisis, that actually really ate into their income. And so that's why part of the reason Jon Corzine, in addition to his sort of risk appetite, went into these trades in European bonds. So when when MF Global first went into these repo-to-maturity trades, I know that's a key thing that I'd love for you to explain. What money were they using? Were they using their own money and not client funds?
Yes. And a good point you had too, which kind of adds, as I mentioned, there were a lot of moving parts to the MF Global story, but one of the parts you mentioned too was, after the financial crisis, where the Federal Reserve dropped overnight rates down to zero, if you're a futures FCM, let's say call a futures broker, like that was MF Global's traditional business. Rule of thumb is that I've worked at a futures broker before. So rule of thumb is that the commissions you make off of your customers pays your operating costs. And then the money you get investing your customer funds, is your profit. Just general rule of thumb at a futures FCM. So what happened was with MF Global was, after the financial crisis, interest rates went down to zero. So there's really no money to make investing. So, you have a company that's kind of like, operating, probably flat for a few years. And then they hired Jon Corzine, and he was going to expand it and make it into a, mini Goldman Sachs. Getting back to your point in terms of the mechanics of the repo to maturity. And I certainly went into it in my book about MF Global, the Money Noose, which you held up before. I'm actually in the process of just finishing another book called the Repo Market Shorts, Shortages, and Squeezes. And I will, and it's about the repo market. Right now, there are no really good books on the repo market out there. There's the Marshall Stigham's book, which was written in the 1980s. There's a professor in London that wrote some very expensive repo handbooks, they're called. And they're okay if you don't want to look at the math of the repo market. But my book that I just am about to finish, goes through, basically it's one part, let's say, textbook about the repo market, but don't let that scare anybody away, because it's also one part stories and history. So it's kind of, why we have tri-party, why there's negative interest rates, where negative interest rates start, and why securities disappear from the market and are squeezed anyway. So that's my plug for the new book. Hopefully it'll be out in a couple of months.
I'll be a
But I do have
buyer.
a chapter.
I'm a buyer of that book, Scott. So we'll get into the repo to maturity, because I'll get into the mechanics. But first, you said something I want to follow up on. You said, "Oh, broker dealers make their money by investing their client funds." I thought that the whole thing was that they're not supposed to invest those funds.
So futures FCMs. So look at it this way. So if you're a hedge fund and you're trading futures, you've got to, the exchange requires some margin to be deposited at the exchange. And the futures broker collects margin from their customer, like let's say the hedge fund. The hedge fund gives the futures broker, let's say MF Global, $1 million in margin. And the futures broker can take that cash and they can invest it in like a treasury bill, and then deposit the treasury bill at the CME exchange, to cover the margin. So basically, kind of, there's a way you take the customer cash, you make it into a security where you earn interest, and you can also invest in repo also, but then you deposit it at the exchange, and then the futures FCM makes interest on that money. Now, big customers will have a split arrangement with, their futures FCM, but a lot of the time the futures FCMs don't pay any interest on the futures margin, and that's a big source. Look at some of the big futures FCMs that have, let's say you got $1 billion in customer seg funds. If you're making, overnight interest rates 3 3/4, you're making 3 3/4 on $1 billion. That's a lot of money these days. It was zero back in 2011 with MF Global, but now it's a significant amount of money. And as a side note too, if you want to shop around and you want to buy a futures FCM right now, there's none for sale. They're too expensive now. They're really cheap 2 years ago, but if you want to buy a futures FCM right now, they're making a lot of money because their interest rates are much higher. So at MF Global, before 2011, for a long time, they had a policy that their customer seg fund cash, their securities might have been deposited in that segregated account at the end of the day for the previous day. Then the cash came out of the account into the broker dealer's own account the next morning. So it was kind of like an omnibus account between the customer cash and the broker dealer. So during that period of time when MF Global was Man Financial, before they were MF Global, they were a small futures broker and they were in fixed income. And they were not large. So when they had this omnibus account with the customer funds and the actual funds of the company, it would be cash management. There'd be money wires coming in, money wires going out, margin calls coming in, margin calls coming out. And then by the end of the day, their policies and procedures stated that they had to have the customer funds back in the customer seg fund account by the end of the day, the full amount. And what's really interesting too is that, when you look at how reports are done in the financial industry, is that they run an end-of-day report. So if the money came out at the beginning of the day, as long as it's on the report at the end of the day that shows money in that account, it doesn't look like it's been in and out of the broker dealer's proprietary account during the day. So if you looked on their, if you looked on their financial reports, it just always showed the customer funds in the account, but they were being used during the day. So now fast forward to October of 2011 when MF Global was going down, and they had already had significant amount of margin calls. I forget the exact amount. So I mean, maybe they had 2 billion in capital. I'll just throw that number up. They're probably using 1 billion in capital to support their repo-to-maturity trade, and then they also had to leave margin at their clearing account at JP Morgan Chase. They had margin sitting in LCH ClearNet, in FICC, and DTC. So all these places, were using firm liquidity. And what happened was during that period of time, all of a sudden, MF Global printed a bad earnings report. They printed a bad earnings report. A bunch of customers took their cash out of the company, and they were worried about, something might go down at the company. It might not be good. Now, of course, when you have a run on the bank, like, if you picture everybody lining up at the bank in the 1930s waiting to get their deposits, if everybody, like in Bedford Hills, if everybody just takes out the amount of money that they need, the bank's fine. But if everybody wants all their money, there's not enough money sitting in the bank. So basically, you had a lot of liquidity being used up at MF Global for a lot of margin for different things. And then you had customers coming in and started taking their margin out, and they had margin calls. And then what they found was at the end of the day, they didn't have enough money to put all that funds back into the customer seg fund account. They assumed they would, because that's how they always operated. But there was so much margin that went out from customers closing accounts and things like that, that there wasn't enough money at the end of the day. So that's what happened to the customer funds. And then, of course, it happened the next day. There was less money, and then there was less money after that, and less money after that. So it was kind of a downward spiral from there. That was always, a crime. It was always a crime to use customer money. Kind of interesting too. There were really no consequences in MF Global. They a lot of fingers were pointed at different people, as to who was in charge of the customer funds and who moved it. The person who actually made the movement, she said her boss said it was okay, and her boss said, as per JC, implying Jon Corzine. So in the end, nobody went to prison for that.
Wow. The parallels are stunning, and I was just being hit by a wave of just the parallels as you were speaking. I have in front of me the letter that Sam Bankman-Fried recently sent employees of FTX, and he basically explained what happened. And he says, I did not realize the full extent of the margin position, nor did I realize the magnitude of the risk posed by a hyper-correlated crash. The loans and secondary sales were used to reinvest in the business and not for large amounts of personal consumption. He mentions a run on the bank triggered by, quote, attacks in November that basically forced about 5 or 6 billion of liquidations. And it's that for FTX, they simultaneously did not imagine that all of their collateral would collapse in value at the exact same time as their depositors or clients would pull money at the exact same time. So I think Sam is kind of like, my models. I ran my model, and it said that this would never happen.
Right, exactly. Because in the risk model, you don't have everything happening at once. But then there is correlation, because once a run starts, it cascades and it goes into it spreads, and that's one thing with the financial markets. Every few years, you have this kind of correlation risk, and it spreads and it builds. I mean, you have March of 2020 with the COVID, with the COVID crisis in March of 2021, people couldn't sell their U.S. Treasuries. That's crazy. So that's what happens. It happens to be, there's a run quote on the bank, and a lack of liquidity, because the markets decline so much, that prompts customers to close their accounts and pull their cash out of the exchange.
Yes. One thing that really stood out for FTX is their complete lack of controls, their complete lack of records. You have an $8 billion quote fiat liability that I mislabeled it just on a single cell on an spreadsheet. I mean, to be fair, is way worse at FTX. I mean, the bankruptcy new CEO who literally took Enron out of bankruptcy said this is the worst thing I've ever seen. They don't even know how many employees FTX has. But
Yeah.
there are parallels to MF Global. I'm reading from your book, page 188, that there was a time that they thought a $540 million liability. It actually was a $150 million asset. So it sounds like those sort of poor record keeping and inability to track the money was at MF Global too.
Right. And I will tell you, as I said, I'm not an expert on FTX, but when I've watched the news shows, a couple of YouTube videos I thought were pretty helpful. I look at it, I'm like, this is a bunch of kids. It was a bunch of kids managing all this money. And of course, it was promoted that way because the idea is that, these tech kids, know how to, build these businesses and stuff. But there's a core old business of customers executing trades and protecting their money and everything. And I remember one job where I worked. It was part of ING Bank back 20 years ago. My boss there, we were getting into a new business, and I said, well, I'm starting this business. Why don't we put me as the business head? And my boss said, no, they like FINRA likes to see a lot of gray hairs. When somebody's like looking after the business. So and I didn't really have as many gray hairs back then. That was 20 years ago. So it's so true. I mean, that probably would have been a much different thing if, had they hired an experienced CEO or CFO and compliance officer and had somebody, with long years of markets experience. It certainly wouldn't have hurt.
Yes, I think the team there was very lacking, a total lack of gray hair. And I also think their head of regulation or compliance officer, he used to work at a online poker company that scammed people. So
Yeah.
definitely some personnel issues at the
Yeah.
firm. One thing last night, I was listening to some Sam Bankman-Fried interviews from 2021. And folks listening to this have to remember that up until a month ago, people in crypto, as well as people, mainstream non-crypto people, sort of worship Sam Bankman-Fried, thought he was a genius. I will admit I was bamboozled by it. I did not do my own due diligence, but I listened to the due diligence of others, which turned out to be incorrect. Or no one did due diligence. I just sort of said, oh, the people who everyone else respects him, and I think a lot of people made the same mistake as I did. So in 2021 he insane quote he says, and this is the exact quote, he says, I think leverage in crypto makes crypto safer. So that's an exact quote. And then he also talked about cross margining, a term that I have a very shaky understanding of. I'm sure you know a lot about that. What is cross margining? He basically was saying all these other exchanges, they don't allow cross margining, but we do, and we have superior risk metrics. So what does that phrase mean, and what might he have meant by that?
So traditionally in, outside of the crypto space, and it probably means the same thing in the crypto space, but, I know the broker dealer space and in the fixed income space. So cross margining, if let's say you've got a customer in fixed income, and this is related to MF Global also too, who's long 100 million treasury 2-year notes. And, if you're going to margin them on those treasury 2-year notes, you might, like the true risk might be 0.25% would be an appropriate margin amount, maybe 0.375 of 1%. But now let's say they also have in their futures account, they're short the 2-year futures contract, and let alone that they're not the exact same implied treasury between the two. But let's just say that they're long the 2-year treasury note, they're short the 2-year treasury futures, and the futures account, charges 0.3%, for the margin. Now, if you look at, both of those trades separately, you've got long 100 million, short 100 million. If you look at them both separately, they're the margin is 0.3% on either side. But if you combine them together, there's very little risk. It's a spread risk between the two markets, and maybe the real margin amount should be about a 1/16 of 1%. So basically, cross margining is, you look at, sometimes in equities world, it's kind of called portfolio margining. In fixed income world, and you look at multiple products and you margin them based on like their portfolio, or all their positions together.
Okay, so you're taking advantage of a spread between two things that are very similar. So if you go long one thing and short the other, the idea is your risk is mitigated.
Maybe in crypto you're long, you're long Ether, and you're short, Solana or something like that, or something like that. So you kind of say that, okay, I'm long one crypto, I'm short another. That there should be some correlation. Now, of course, there's a correlation until there's not, and that's what people remember. I still remember back in the 1990s, there was this hedge fund. What was it? I can't remember offhand, but they had a great trading strategy. It was in the mortgage-backed securities market, and they were long IOs, so they were long interest-only portion of the mortgage-backed securities. They were short POs, principal only, or no, actually, wait.
That was long-term capital management, right?
Yeah, Askin, that's right. I think they were long the IOs and long the POs, and short the bonds, against those. So, a bond is interest, a bond is principal. And so they're along the two components, and then they're short the actual bond. And you'd think that, hey, how can that lose money? You're long and short the same components. But when the market breaks down and there's no buyers, then the spreads widen, and there's nothing you can do, because your prime broker says, even though you put them together, they're the same security. Well, right now, the bid side is this and the offered side is this, and you owe us $1 million in margin, pay up.
Right. And I suppose this is a conjecture, but, I have studied the balance sheet, if you can call it that Sam Bankman-Fried provided on based on November 10th. And there was like no Bitcoin there. There was not a lot of Ethereum there. It was a lot of Solana and a lot of essentially tokens that he had invented, or he really had invested a lot in. And maybe he's saying, oh, I'm exposed to crypto. You know what I'll do? I'll short Bitcoin. I'll hedge my long FTT position by shorting Bitcoin. But the problem is, Bitcoin is a decentralized network. Millions of people around the world think it's the hardest money ever, whereas FTT was a token that he's kind of conjured from thin air. And, he and his empire owned the majority position of it. And, incredibly thin volumes. This is another thing that I actually think it's far worse than MF Global in this terms of, they were valuing on their balance sheet assets that were 100 times larger than the daily traded volume of the entire token. So yeah, in some cases 300 times larger. So it was a very thinly traded token, kind of somewhat of a manipulated market, if you can call it that. If you look at the flows, it was very circular. FTX was lending it to Alameda, who's lending it to, I'll go back to FTX. It was very circular.
I see that in my market too. We've got customers that come in and, they're short 700 million or something, and, and 200 million trades, in the broker markets every day. And they want like a market price. And we're like, sorry, we'll work with you. We'll do our best, to get you done. But, we just can't offer, like right at the market, and only a fraction of what your short trades every day. I'll throw something into, back a little over a year ago, I had an idea that I pitched to some of our clients, and I wanted to go short the stable coins, because I felt that the fact that they weren't very transparent. I think they're more transparent now, but I saw that they weren't transparent, and there's, look on the internet. There's a lot of questions of where that money actually is when when you give them cash in a stable coin. And we talked about it, but we couldn't figure out. We look, fixed income people, we like to look at things as spreads.
Mm-hmm.
You're long something, you're short something, you're long cash, you're short futures, long one treasury, you're short another. That's kind of how you trade the treasury market. And we couldn't figure out what to own against it. And so we eventually kind of gave up on the trade. Now, of course, one of those stable coins, which one, Luna, ended up collapsing six months later.
Yeah. Terra collapsed, and Luna was the utility token that increased in value the more that
right.
when excess money was flowing into Terra, and it would have gone above $1, that money was going to burn, i.e., buy back Luna. So that's why Luna exploded higher. Luna is now worth 0. Terra, I think, also worth 0, but they changed it. It was so bad they had to change the name of the token. So yeah, you were exactly right about that, Scott. I think it is quite hard to short those. I actually was listening to Sam Bankman-Fried, an interview from 2021, and he said, "Look, I think Tether's fine, but Tether is the largest stablecoin, which now still trades at $1, and mostly has stayed in that range. Although they do not have an audit, they have an attestation about what assets they actually hold. And interestingly enough, Tether does a lot of business with Alameda, or at least it used to. But Sam said you can bet on whether Tether or not is going to be a thing. So let's say instead of Terra collapsing, it was Tether that collapsed, and you had wisely taken out a short position on Tether, so you would have made money, but you would have made money on the FTX exchange, so you actually would have not been able to withdraw.
Right. Yeah. Think of that too. That's ironic.
Yes. So this spread trade, I think, is really. Oh, sorry, Scott. When you said whatever client, I don't want you to disclose anything, but they were short something that's 700 million and 200 million was trading. Are we talking about treasuries here?
Yeah, I was in the treasury market. Yeah.
Okay. So that is, every single treasury security is different, and a 7.5-year note is different than an 8-year, which is different than a 9-year. But it's all part of this. Every single treasury has a treasury-ness quality to it. Whereas in crypto, FTT is really nothing like Bitcoin. So it's way worse.
Right.
But Scott, okay, so this spread issue, I think, is on full display with MF Global's Repo-To-Maturity trades. So what were those trades? Number one, of going long certain something, going short the other. And that's my first question. The second question is, what's the mechanism of Repo-To-Maturity?
Okay. And so I'm going to give you a little background. It should not be too technical. So in the history of the fixed income markets and the treasury market, we used to do these things called Repo-To-Maturity. And basically, it was always done with very short-term U.S. treasuries, like a treasury bill. So let's say that you had a customer that had a 6-month bill, and they wanted to sell it to you. And so you could buy it, but then, what if the 6-month repo market, so in other words, you can loan that security for 6 months to somebody, was at a lower rate than the actual yield of the bill. So in other words, you can buy the treasury bill at one yield, let's call it 3.5%. And then as it turns out, the 6-month term repo market is trading at 3.40. So you can lend that bill in the repo market, kind of like selling it to maturity, and then you've locked in 10 basis points. And that was a big trade in the treasury market for a long, long time. If it basically, in a way, it was kind of like an arbitrage between, actual treasury bill yields or short coupons, would happen with very short coupons, and the repo market kind of keeps, short-term rates, in balance. And those trades still exist. People still do those trades. They're out there over in Europe sometimes in the U.S. But there's a lot of people ready to jump on that arbitrage. So traditionally, that was called a Repo-To-Maturity trade, and how the accounting worked for it was that the accounting firms recognize that as what they call a true sale. So in other words, if you owned a treasury bill and repoed it to maturity, the accounting firms would account for that, lack of a better word, as a true sale, so that it would go off your books. So you own the bill, you repoed it to maturity, it's taken off your balance sheet because they call it a true sale and it's a locked in profit. And even though it's really sitting there as a, with a repo, the accounting firms call it a true sale, therefore it comes off your balance sheet. So, and that was always done for years and years in the U.S. Treasury market with Treasury securities that are AAA rated, risk-free. So basically you're dealing with risk-free securities. So that trade's been around. People have done it over in Europe. And now what happened was you had the invention of the euro. And then all of a sudden countries like Belgium and Italy and Spain, they're not on their own currencies anymore. They're on a hard currency called the euro. And traders started doing repo to maturity trades in European, and it made it much, much easier, with all these countries that were on the euro. Now, when all these countries were fiscally stable and the yields of their 6-month bills and bonds and notes, were all relatively similar to the rates in other money markets, like the repo market. There's really no arbitrage. But then what happened was, as the European debt crisis was creeping up, then all these countries, the pigs as we call them, were selling more and more debt. Basically these countries were addicted to spending. They couldn't do austerity. That was a big term 10 years ago, and they kept issuing more and more debt to pay their kind of generous spending budgets. And as they issued more and more debt, their yields went higher and higher. So then when you got to the point, so let's say that we're using the same example as before, that the 6-month rate in the repo market was 340, and a treasury, which is AAA rated, is at a yield of 3.5. But now let's say that the Belgium, 6-month bill is at 3.75, and Italy is at 380, and Ireland is at 360, and Portugal is at 390. So all of a sudden, all of these, sovereign country debt, because they issued so many securities, their yields went high, and their yields went high. It basically created an arbitrage in the repo to maturity market. So MF Global went, and using the same rates as before, they went and bought, 1 year or 6-month Portuguese bonds. And what did I say? They were at 390, and bought them, owned them at 390, then loaned them to maturity, repoed them to maturity at a 340, and they were locking in 50 basis points there.
So Scott, just to be clear, so this is exploiting the spread between a 6-month Portuguese yield to maturity and the 6-month Portuguese repo rate. It is not exploiting the spread between the 6-month Portuguese bill and the 6-month German Bund yield, right?
Correct. It's basically buying the Portuguese bill for 6 months and then repoing it in the repo market for 6 months. And of course the repo rates are a money market rate, that kind of follows, what the ECB is doing. It's kind of, prices, where their overnights will be, rates will be for 6 months. So in a way they're two different markets. And when you have two different markets, there's potentially an arbitrage between the two. But, what was unique, and this may be happening again in the next few years, but what was unique was that there was a lot of issuance of European debt, spreads widened, and when spreads widened, there was an opportunity in there. So what happened was, MF Global bought all sorts of Ireland, Belgium, Italy, Spain, Portuguese bonds. They stayed away from Greece because that was, everybody knew that was a mess. They bought all these bonds, 11 billion of them, and they repoed them to maturity. So they kind of had an arbitrage locked in, and they were making, I forget the exact numbers. They might have been making, They were making a lot of money. I think it was like $25 million a month or something, just on this trade. And and here's the sweet part about it: as a repo to maturity, the accounting firm took it off their balance sheet. So it didn't look like they were in these trades at all because it was a repo to maturity, which was an off balance sheet true sale at the
Wow.
time. So,
But it still, this trade still existed. It did not
yeah,
appear on something an investor would read. You just had to go beyond the
right.
balance sheet.
Like you can look in the notes and you can see, hey, we've got 11 billion European debt that's financed to maturity. So, so then of course with MF Global, a lot of events happened where eventually the FINRA, the regulatory agency in the U.S., and their accounting and MF Global's accounting firm said, hold on here.
Yeah.
You got 11 billion of these things. They're not risk free. There's obvious risk here. That can't
What
be
is that
off
risk,
balance.
Scott? What is that? What is the risk there?
Well, so the number one, so there's the risk that MF Global suffered, and then there is the obvious risk. So the obvious risk is that Portugal defaults and doesn't pay their debt. Or any one of those countries defaults and doesn't pay their debt, which is an unlikely outcome. Most likely they would default. They wouldn't pay their debt for a few months. The ECB would put together a plan, to save them and finance them. So maybe the real risk there was that, the debt might not be paying for a short period of time. Now, so that was one risk. That's like the default risk. Then there's the liquidity risk, and this is what MF Global really dove deep into, and they had their hands slapped pretty hard on this one. Was that if the European debt crisis occurred like it did right after they got into this trade, then the value of the bonds were declining. So the price of the bonds were going down, but they had already repoed them to maturity. But when they repoed them to maturity, those trades were in the European Central Clearing Counterparty, which is like an exchange, like LCH ClearNet. So, or think of the futures exchange. So, even though they're bought and sold, they still have to pay margin to finance the bonds. So then as the value of the bonds went down, LCH ClearNet kept calling them for more and more margin. And then as the European debt crisis began, the margin percentages went up because the markets were more volatile. So then all of a sudden, and I forget the numbers in the book, that was a while ago, but as I said, at one point they're paying at least $500 million to LCH ClearNet, to cover the margin. And of course, they would get all that money back when the bonds matured, but they just had to hold out until the bonds matured. And with MF Global, a large percentage of their repo to maturity trade matured in December, and they went bust in October. Like they were really just 2 months away.
FTX had the same issue, but instead of 2 months, it was 2 years, or in some cases 5 years. It had this token called SRM, which it was valuing at its balance sheet a month ago at about $5 billion. But that's the token where literally they had 300 times more than the daily traded volume. 99% of that token was locked up, and it had a vesting schedule or a inflation schedule that it would be public for a number of years. So they were valuing assets and taking liquid, deposits that could be called at any time against assets that were 5 years in duration.
Yeah, and you hit it on the nose here with all these parallels. Like, with me, I kind of saw, okay, company collapses, money missing. That reminds me of MF Global. I think you see a lot of the depth related to the two. It's very interesting story. And to tell you the truth, I didn't think an MF Global was going to happen again. After MF Global happened, the FINRA and the SEC and the CFTC came down really hard. Like there's very tough policies and procedures for moving customer seg cash around. I've worked at broker dealers since then, and I've managed seg fund cash before myself. And you cannot you cannot intermingle anything in terms of the seg fund cash. So they have really tight rules in the U.S. But then, of course, not in the Bahamas.
Exactly. You were right. It did not happen in traditional finance, American capital markets, but it happened in the Bahamas. And it was so obscene that there was $8 billion that I don't, and this is a theory that is based on a Twitter DM that Sam Bankman-Fried sent to a journalist, but he pretty much says that $8 billion that Alameda owed FTX, there's a likely chance that it never was at FTX. So when you wired money saying, "Oh, I'm going to put my money in FTX because I want to go long Bitcoin, or I want to go short Tether, or I want to go long Solana, short Ethereum," that money went to Alameda. And this is another parallel, which is that the cohabitation of a hedge fund prop shop within a brokerage and an exchange.
Yeah.
Alameda Research was a hedge fund that Sam Bankman-Fried started first. Then he launched FTX, and on paper they were separate entities. And he technically stepped down as CEO from Alameda Research. But it's quite clear now that they were the one and the same. And if Alameda booked a loss, it was FTX's loss because Sam Bankman-Fried was going to make sure that they covered that loss. In the traditional financial world, there's some of that, like Goldman Sachs has a prime brokerage business. They also have a large proprietary trading shop. After the great financial crisis, it's much less, but there's some amount of it that can occur without everything blowing up. But within MF Global, I think that was another thing where you had this kind of sleepy brokerage business that Jon Corzine wanted to inject a lot of the sort of high finance profits into by importing teams from Goldman Sachs and other trading shops. And it's tough when you have a brokerage business, but on the other side, you have people who are trying to make as much money as they can trading.
Right. Yeah. Exactly. And that was with MF Global. You had basically a prop shop that was layered on top of a futures FCM, and you can kind of see, like, at banks with Dodd-Frank, they've taken a lot of the what was it called, the Volcker rule, where they took a lot of prop trading out of the banks. Now, of course, MF Global was a broker dealer, not a bank, and not subject to Dodd-Frank. So in a way, there's a loophole there. But yeah, so I mean, I would think, but a lot of the banks also, they have an asset management group, and they have hedge fund affiliates. So banks can have prop trading businesses also, but it can't be inside the bank.
Right. Before I pick your brain just about the repo market right now, I want to throw two more parallels at you between FTX and MF Global. One is a stubborn CEO with political connections and a heavy risk appetite who is surrounded by yes men. And the second is the potential acquisition by a savior that is later terminated. Binance was rumored to buy out FTX and rescue FTX. It didn't. MF Global had a similarly same fate. Tie a bow on this story for us, Scott. What happened? Who was the potential savior for MF Global, and why didn't it go down and Global had to declare bankruptcy?
So if I remember correctly, there were a couple suitors for MF Global, and of course the first one I think was J.C. Flowers, or J.C. Flowers might have already been an investor, and
He was.
J.C. Flowers, I don't remember his actual first name, but he was a Goldman guy. And even if you look in the book Too Big to Fail,
Yep.
When Lehman was going down, he was like in the room trying to get a good deal for Lehman Brothers. So I think J.C. Flowers was part of it. Interactive Brokers also. Thomas Pettifree, I think is the pronunciation. I did speak with him on the phone about their looking at MF Global, and he's a very smart man. He basically said, we had a team. We looked at, some of their, like their financials. And he's like, and we didn't want it after that. But that typically happens. And to tell you the truth, with my experience in the industry, which goes back a lot of years, is that anytime a company's going down, there's parts of it that are good. And people on the street realize that there's going to be some good businesses there, and somebody might be out there to buy the whole business. But sometimes you can kind of pick the carcass, once it's gone. So there might be a metals trading group there,
Mm-hmm.
and you go in and you just hire the people instead of having the legacy company that's got legal problems. So in the end, I know a few people looked at MF Global and nobody wanted to touch it, but I can tell you that I'm most 95% sure that the good businesses at MF Global got picked up right away and moved to other places.
And so MF Global had to declare bankruptcy because there was no suitor. How much money what percentage of their funds did clients get back? Did investors get wiped out? Did bondholders get wiped out? Where in the stack was it? Was it clients, bondholders, stockholders? Was it different? And also, how long did it take for this to get settled out, for people to get their money back?
So this is kind of interesting too, because when I started working on that MF Global book was a couple months after they went under. I probably started working on it in March or April or May, after they went bust in October. And I started looking at it and reading regulatory filings and things like that, and listening to testimony. And the bottom line is the money was never really missing; it was always somewhere. So basically, what happened in the scramble to meet margin calls, that customer cash ended up going somewhere to meet a margin call at LCH ClearNet, FICC, DTC, JP Morgan Chase. So, and then once MF Global went bust, everybody clamped down on their money and held it as much as they could, because there were potential legal proceedings with somebody who's doing business with MF Global. So everybody held on to their cash, and that cash existed somewhere. So it's really then a matter of kind of like mopping it up and getting the cash back. Once they got the cash back, all the customer money was eventually repaid. It took a few years, and I forget the number, like 80-90% was paid within a couple of years. And then after that, MF Global did have some bonds that were trading, and I remember within a year or so, like a lot of the MF Global bonds were trading at, let's say, ballpark 50 cents on the dollar. So the market kind of expected that there was money left over and the bondholders would be paid, but not the full amount. So the equity was wiped out. But then there was money left to pay at least some of the debt. But all the customer funds were eventually repaid.
Wow, that is optimistic, and I hope that is the case for all clients with FTX. I have a fear that it won't be true, and I think MF Global was a disaster story for sure. And for people who want to know the details, they got to read the book.
There you
But
go. Thank
the
you.
Money Noose for FTX, I think, was way tighter because they did things that MF Global did not do. They had $8 billion that literally was never in their bank account. It was in their sister bank accounts. They essentially created securities out of thin air and valued them at market prices, even though it was a ridiculously thin market price, and some of the tokens wouldn't even start to exist until years later.
But I get what you mean, and yeah, it's true. It's so much, it's more complicated in a way in the crypto world, and it's it's not as transparent in the crypto world. And I think there's going to be people digging around in this company for a long time, trying to figure out where everything went.
Right. All right. Well, Scott, thank you so much for sharing your insights on MF Global. So that was, your hobby is writing excellent books about finance, but your day job is working in the repo market. And what are you seeing now? Where's November 23rd? Repo rates. How would you characterize the repo market at this time? What are the new developments, and what do you have your eye on?
So I'm going to talk about a kind of a large concept with the repo market, and anybody out there that wants to learn a little bit more on the repo market and my thoughts, I put out a white paper about a month ago called "The Fed's Dilemma," and it's floating around the market. Zero Hedge picked it up and published the entire thing on their website. And last time I checked, there were like 50,000 views. So that might be a good thing to kind of summarize, because I think, in something that people can relate to, that's kind of the most interesting part about the repo market right now. So here's how I see it. Right now we're doing what they call is balance sheet runoff, with at the Fed, and the Fed accumulated an $8.9 trillion balance sheet, over the last few years, basically to finance government spending. I'm not going to put blame on, who spent all the money, but a lot of money was spent in Washington. And if you spend a lot of money in Washington, you have to issue Treasury securities to finance that spending. Luckily, they had the Federal Reserve out there willing to buy the Treasury securities and take them all out of the market. Now, the mechanics of it is that when the Fed buys securities and puts them in their portfolio, they pay for those securities somehow. It's called money creation, and effectively they create money out of thin air. So as the Fed was buying securities for the QE SOMA portfolio, they were putting cash into the market. So at this point, if you think that Milton Friedman was right, or even a little bit of right, and he said, let me try to get the quote right, that inflation is always a monetary phenomena, something like that.
Yeah.
So if you believe that, more money floating around the market at least causes some inflation, you kind of realize that the fact that the SOMA portfolio is so large means that there's a lot of money in the market right now in the financial system. And it's my belief that the price of oil, supply chains, those are somewhat excuses as to why we have inflation. I think the number one reason why we have inflation right now is because of the size of the Fed's balance sheet and the amount of liquidity that they put into the market over the last few years. And the Fed has a dilemma right now, because if they take those securities out of the Fed's portfolio and put them in the market, something's going to break. So you've got balance sheet runoff, and the Treasury is still issuing a lot of money, and you have about $175 billion of securities coming into the market every month via the Treasury or the Fed. And that's a lot of securities for the market to absorb every month. And at some point, something's going to break, because you can't have that many securities coming into the market. So therein, in my view, lies the Fed's dilemma, is that they want to shrink the balance sheet because they've got to control inflation. But if they shrink the balance sheet, they're going to be putting a lot of supply into the market. And if they put that much supply in the market, something's going to break. So that's, if you're going to call. So my long-term prediction right now is the Fed kind of has a choice. Either they're going to control inflation, or they're going to keep the market from breaking.
And yeah. And you think quantitative tightening and balance sheet reduction is just as important, or maybe even more important than interest rates?
In my view, the Fed tightening rates is a natural part of the market. We've been through it, ups and downs, many times before. So it's something that happens. Rates tighten. It slows down the economy. And that's a natural mechanism of the financial markets. It's balance sheet runoff was only tried once before, and eventually the repo market blew up in September 2019. And at that point, they only put $670 billion worth of securities in the market. And right now, we're going to put, so right now the Fed and the Treasury is running at a pace of putting $1 trillion of securities in the market every 6 months. So I would say, if my view, and of course there's more details in my paper, and I'm sure you could someone can look up on Zero Hedge and find the paper, look up my name. But I think that's something, and maybe in 6 months you can have me back, and I can say, hey, remember 6 months ago, people need to watch your podcast more, because they're getting good information here. So that's kind of my biggest prediction and stuff with the markets. That's the Fed's dilemma.
There we go. Thanks for explaining that, Scott. So in terms of the Fed can either stop inflation or fight inflation by continuing to do quantitative tightening, balance sheet runoff, or they can um, not have something break, but they're going to have something break. So when I hear something break, there's sort of kind of four things. Number one, the economy breaking. That's commonly called a recession. We all know what that looks like. Number two is risk assets performing poorly. So that's equities performing poorly, crypto performing poorly, high yield bonds selling off, investment grade high yield bonds spreads widening significantly. So those are bonds, but they're risk bonds because they have credit risk. They're tied to private companies. But then door number three is what we saw in March 2020, very rare, where the treasury market itself breaks down and there's no liquidity there. And even though you're headed into a giant recession, bonds sell off and yields go up instead of fall. We saw that in September with the UK market. And door number four is your world, the repo world, which is what happened in September 2019. So how are you sort of weighing the probabilities of which is the most likely case? If the Fed continues QT and if you're right that something will break, what do you think it will be?
I don't know. I will know before it happens, I think. But at this point, something's going to break, and your four things are really spot on. I think it'll be something. It'll be something in there, and yeah, I think that some problems are going to arise, and all goes down to the Fed's dilemma of which choice they're going to make. Now, of course, if anyone wants to if anybody's involved in the repo market and needs repo financing, you've got my name, you know where to find me. And I provide a lot of information on the repo market to our clients, and I think they're better off, in their financing positions because they get a lot of good information that they can't get in other places.
Mm-hmm. Yes, definitely. Your daily reports, which whenever I interview, I'm lucky enough to get access to, are excellent, fantastic charts. The repo market is financed with cash, not cash, in your wallet or a bank deposit, but bank assets, which is like the liabilities of the Federal Reserve, which is how what they do with quantitative easing. So when quantitative tightening, the amount of money in the banking system is going down. That money is what's used to finance the biggest market in the world, the repo market. What does repo stress look like? Yeah, can you just walk us through, you know, what a September 2019 looks like, and then is that on your bingo card of the year, and then what is the health of the repo system as you see it right now in mid-November?
Yeah, so I think the repo system is very healthy right now. And there's more supply coming into the market, and bank balance sheets are going to be tighter going forward because banks and broker dealers like my company are intermediaries, and we finance positions in the U.S. Treasuries in the repo market for our clients. So the repo market's functioning just right now. Year end will be kind of interesting. We'll see if there's some tightness in bank balance sheets, and there's no problems at any point. Also, with the September 2019 repo market panic, as I called it, I actually put a white paper out about that, which Zero Hedge picked up also. So you can probably search Zero Hedge and find that. So if you want a lot of details about the repo market panic of September 2019, it is out there online. But other than that, the repo market is going to be very interesting. The repo market is if the financial industry is the part of the engine of the economy, the repo market is the grease that lubricates the engine, because when you can borrow and lend cash and borrow and lend securities pretty seamlessly, it's very easy to buy and short sell, and it's very easy to have very liquid and tight spreads in the market, and it's very healthy for the market to have a repo market that's very seamless and liquid. And there's no problems in the repo market at this point, but I fear down the road there's going to be some issues.
What about the reverse repo facility from the Fed, which has, I think, over $2 trillion in it? Why was that so big? And uh, will that money that's kind of the $2 trillion locked in the reverse repo facility, can that kind of rescue the illiquidity in the bond market?
So I try to get out of the weed. I try to stay out of the weeds, and you want to put me in the weeds. I'm happy to go in the weeds. It's okay. I just
My audience likes
don't
the
want to
weeds.
lose too many. I don't want to lose too many of your listeners.
We got the ending. That's why the end of the only true fans are here.
Yeah, exactly,
Yeah.
exactly. Someone really must like the repo market to be here this long. So here's what is going to happen. In the repo market over the next few months, and it's already starting to happen now. So the RRP facility got as high as maybe 2.3 trillion or so, and what the RRP facility is that it's a holding tank for liquidity. So because the Fed did too much QE and they took too many securities out of the market, injecting too much cash into the market, money market funds, all sorts of investors ended up, with a lot of cash. So ironically, the RRP facilities where cash investors like money market funds, bank investment portfolios, they can give cash to the Fed and get paid an interest rate on that cash. So what the Fed did was they bought too many securities, injected too much cash into the market. The market had all this cash, but it was too much. So they ended up giving the cash right back to the Fed and investing it at the Fed. So, really when you look at it, it's a clear sign that the Fed, kept QE going way too long, probably $2 billion worth of cash injection too long.
Right. So, Scott, officially, the reverse repo facility is a facility that allows commercial market participants to be a reverse repo, in which the Federal Reserve itself is a repo. So, commercial banks, quote, sell, they lend their treasuries to the Federal Reserve as if the Fed needs securities at all, and the Federal Reserve pays interest on it. So it's effectively, not really, but it's effectively a deposit.
The opposite. So the RRP is a reverse
Sorry,
repo
yeah. I
facility.
always get
Yeah,
confused.
you had all the mechanics, but it was just the opposite way. The market participants lend cash to the Fed.
Yes.
So, but everything else there was correct. So basically, there's 2.1 trillion right now. We're down 100 billion in the RRP in the last 2 weeks. Interesting. So the RRP facility is 2.1 trillion right now, and as more securities come into the market, the repo market is going to need more cash to finance those securities. So the money market funds that are giving cash to the Fed are going to start giving that cash to the banks and broker dealers to take treasuries that are coming into the market from balance sheet runoff and new treasury issuance. So as there's more treasury issuance and balance sheet runoff, it's going to drain cash from the RRP. And that might take a year or so, but at some point, the RRP is going to be down to zero after there are enough securities that came back into the market from balance sheet runoff, aka quantitative tightening.
So isn't it true though that money market funds can only buy short duration like treasury bills? So in order for it's not as if they're taking their money out of the RRP and then they're plopping it into a 20-year treasury. They can only buy very short term, I think zero coupon bills, correct me if I'm wrong. So instead they have to lend it to the banks who then buy those longer duration securities. But that's a very messy process, which our mutual friend Joseph Wang says the pipes are clogged.
Yeah, so with money market funds, 2A7 funds, they can go out to a certain maturity. I don't know, it used to be 15 months or something like that. I'm not exactly sure what it is now, but yeah, so money market funds can buy treasury bills, but when they had money market fund reform back in 2015, 2016, 2017, a certain amount of money fund cash has to be invested overnight. And anytime you have money market funds investing cash overnight, it's almost always going into the repo market. So that turnover is money market funds have so much extra cash, they can't go to the banks and invest the cash in repo because the banks don't have enough balance sheet. So, or they don't have enough securities, available to loan to the money market funds. So the money market funds, therefore, instead take their cash and they've been giving it to the Fed in the RRP program. But the mechanics of it is, as there's more treasury securities in the market with balance sheet runoff, is that the banks, and I don't know who owns these securities, it could be hedge funds, it could be parts of the bank, but the banks are going to have more US treasury securities to finance in the repo market, so that the banks are going to offer the money market funds, well, the RRP rate right now that you get from the Fed is 380. The banks are going to have to start saying, we'll pay you 385 if you take that cash out of the Fed and give it to us, because we have more securities now. We can pay you a higher rate. Kind of
right. So the official Fed funds corridor is for Fed funds when they release their announcement at the FOMC meeting. Right now it's between 375 basis points and 4%. Then the RRP rate just a little bit about 380. So you're saying if commercial banks wants to take money from that facility, they got to go, oh, we'll do 385. But then we'll do 390, 395. So suddenly, as money gets a little bit tighter and tighter, it goes up towards the top end of the corridor.
Yeah, exactly.
But then when something, if it goes above the corridor and if it goes extremely above the corridor, that's when you have a real sort of very much a tightness in the repo market, which is what happened in September 2019. But in 2019, the Fed rolled out its repo facility. It said, oh, we will lend reserves to the banks. So do you think that the risk of a 2019 happening again is somewhat slim, not because it wouldn't happen naturally, but because the facility is there? Like, don't worry, the Fed has your back.
Right, exactly. So in September 2019, there was no standing repo facility, SRF, which is just like the RRP facility, but the opposite. So in the standing repo facility, the Federal Reserve takes collateral from the market and gives the market cash. And of course, it's just the primary dealers that are allowed to access the standing repo facility. So it is my prediction that at some point in the next year or two, the overnight general collateral repo rate, which is right at the bottom of the Fed funds target range, is going to be at the top of the range, because there's more supply of securities coming into the market. And then once it's at the top of the range, primary dealers are going to be taking securities from their customers and putting them into the Fed each day in the standing repo facility. Now, so the standing repo facility is there and can absorb a lot of collateral from the market, and theoretically that should eliminate the chance of a rate spike like we had in September 2019. However, with bank balance sheets that are restricted by Dodd-Frank with leverage ratios and special leverage ratios, SLR, there's times when banks kind of close down their balance sheets, and that tends to be on quarter end. So if there is going to be a rate spike, chances are, it's going to be on a quarter end or a year end or something like that, when banks do not, will not be there to add balance sheet to pretty much support the market, because they've got leverage ratios that they have to meet.
There we go. That's called the turn, right?
That we call it the turn.
There we go. The turn. All right. Well, what I want people at home to be doing is turning the pages of your book, The Money Noose. Put it on screen again. It is an excellent book. You are at Curvature Securities. Scott, it's been an absolute pleasure. People can find your work. You are on Twitter at Scott Skyrm, Skyrm. It's been an absolute pleasure. Talk soon.
Great. Thank you. Anytime. Let's do this again in 6 months, and we'll see if anything I said was correct.
I'd love to. Let's do it.
Okay, great.
Thanks. Thank you so much for watching. A few housekeeping items before I let you go. Subscribe to the Blockworks Macro YouTube channel so you don't miss another episode of Forward Guidance. You can find Forward Guidance, the podcast you just listened to, on your favorite podcast app. That's Apple Podcast, Spotify, Overcast, Podbean. That's Podbean as in, on this pod, I've been saying that the Fed pivot is still far away. In addition, please check out today's sponsor. It really helps the show. Link is in the description. Thanks for watching.